Hi, and welcome to this episode of the Insurance Experts. It's my pleasure to have my good friend, long-term care specialist, and tax attorney, Trey Fairman on the line. Trey, thanks for joining us today.
Thanks for having me, Marc.
So not everybody obviously gets their background in tax law and then becomes a long-term care specialist. Can you tell me about the journey to having that happen?
Yeah, sure. So as you mentioned, I'm a tax attorney by training. I have my master's in tax law. Since 1997, I guess, I've been partnering with most of the major Wall Street firms and private banks, helping them do more sophisticated, high net worth estate tax planning that involved life insurance products. So that's sort of where my background has been. And as we all know, that whole insurance marketplace has evolved and changed dramatically. So my first exposure to long-term care insurance was, probably in the late 90s, when a lot of those carriers were looking to have those Wall Street firms and their advisors sell the long-term care products to their firm's clients.
I gotcha. And then what were you finding to be the most popular strategies back then and also now in terms of tax planning related to long-term care strategies?
Yeah, so I think, back in the late 90s, early 2000s, right, the long-term care market. So this is a two-part answer, I guess. The long-term care market was kind of coming out of that period that the products were mispriced, premiums were going up, carriers were failing. Mm-hmm. And then they're entering into the Wall Street community, which is more of an asset-based conversation. So, where it started originally for me was, hybrids, lump sum hybrids, money back products, and kind of then evolving from there. So that's where it started. Those products have obviously changed as well. Couldn't do a whole lot of tax planning with those because they were life insurance chassis. But then as the tax world changed, obviously, we now have more traditional long-term care products structured like the hybrids where we can short pay them. Mm-hmm. And for business owner clients, which I work a lot with these days, those products provide exceptional tax benefits for them.
Yeah, it's very interesting. And I think a lot of this evolution in the market, we see like traditional being popular, hybrids becoming more popular. Now we're seeing a trend back towards traditional again. It all kind of evolves around what the carriers are doing with their pricing, how the underwriting's working, and then the tax advantages. And now we even see, I think, both traditional and hybrids have the ability to deduct it for a business owner. So I think we wanted to talk a little bit about that strategy today. What are your thoughts about doing, business owner long-term care planning? Where's the value proposition for clients and for advisors out there today?
Yeah. Well, I think, first and foremost, any planning, needs to stand on its own before the tax benefits of that planning. So long-term care insurance planning, this is a math exercise, right? So once that conversation starts and we're gravitating towards a product and or solution that then fits, what the then tax part of that says, well, okay, if this is a good financial transaction on its own, if we then use business funds to pay that premium, depending on if you're a pass-through entity like a S Corp or a C Corp, you can deduct 40, 60% of the premium if you're a S Corp. If you're a C Corp, the money's completely tax-free. So the C Corp pays no tax on the premium. The insured owner pays no tax on the premium. And then, of course, we've leveraged that to create the much larger pool of funds to pay for long-term care. That comes out income tax-free as well. So the money's never taxed. So again, on its own, done properly, planned for properly, long-term care insurance works great. And when you couple that with the tax benefits of paying the premium with business money, it's unbelievable, frankly.
Yeah. And, it's funny because I think a lot of people don't realize it exists. In the life insurance or disability world, it works differently. But because long-term care is like health insurance, you get to take the deduction like a business expense, like you would for a health insurance policy. Now, I know you worked with financial planners and you had somebody in mind that you had worked with recently that this was kind of an eye-opening experience with. So much so that she kind of looked at getting her own plan, right? Can you tell us a little about that partner that you worked with?
Yeah, sure. So, much like I brought up earlier, my world's changed, right? So as tax laws changed, you've got high net worth clients that had estate tax problems. Now, if your net worth's under 22 million, you have no estate taxes. So a lot of the estate planning world has become income tax driven. And within that conversation, a lot of it is what I'd call elder law driven, right? So a lot of estate tax attorneys that I've known for 15, 20, 25 years are now elder law attorneys working with clients, helping them plan for long-term care events. So one of the attorneys that I've known for, 20 some odd years, has a lot of clients of that age. They're doing a lot of elder law planning. She reached out to me and said, hey, I've seen a couple of these. I'm in my mid 50s. Her husband was about 5 years older. You walk me through this, show me how it works, tell me what the good is and the bad is, and, kind of outline for me how this all fits together. So
I see. And then kind of what was the appeal from her perspective? Obviously, she was in that range where she wanted to get a long-term care plan, it sounds like, for herself. But what was the kind of the eye-opening part of the funding and the business owner piece of that?
Yeah, so I think, much like a lot of business owners, I would say a lot of business owners kind of are at the age now or reach a point where they have what I call a runway, right? Which is they in their mind have about 10 years left, and they're structuring their business to sell it, to retire, to pass it on to their kids. So that's about where she was. She had about 10 years left in her mind. And what was great about the planning is we walked through long-term care insurance, how we fund it, what the benefit pools are, what the leverage factors are on that, which is great. And then we could say, look, if we structure this for 10 premium payments, so it's paid up after 10 years, but the coverage is there for lifetime, we can write off. Again, she's a pass-through entity, so I think her number was about 64% of the premium. But she was able to budget that and structure that. So over the next 10 years, a portion of her, what would normally be taxable income to her, she was allocating to fund a long-term care plan and writing off about 64% of that. So awesome. That was a win-win. Not only did we take money and leverage it to create a much larger tax-free pool to pay for long-term care, but at a cost that was 64% of it, she didn't have to pay taxes on. So that was great.
Yeah. I won't call it a government subsidy, but clearly the government wants to encourage people to get their long-term care plan. So this is a nice extra value there that they provide. So Trey, thanks for being on the show today and for sharing your knowledge. I'm sure we're going to do more, both webinars as well as videos with you to learn more about these topics and the clients you're working with. So hope to have you on future episodes.
Great. Love to do it. Thanks.